welcome Alok and Nitish. Thank you for agreeing to do this. Uh, the topic that we have been given is very, very interesting, in the context where in the last 3 years, it has been a whirlwind ride for new age companies who have, tried accessing the capital markets through the IPO route, uh, where the outcome for some companies has not been so encouraging. Others like you have seen really successful IPOs. So, who better than both of you to hear on how the journey has been? What do you do to get it right, and what are the pitfalls one should avoid? It will actually serve as a guiding light for a lot of founders who are on their path to an IPO. So first up, Nitish, if you can talk about the journey up to the IPO, and back then in 2021, you were probably the first tech company to just list on the exchanges, followed by Zomato and other companies, in that year. So, how did you time the market? What was the thought back then?
Sure, happy to share that. So, timing the IPO market is always difficult, and we made our first attempt in 2018 actually, right? And went all the way, did all the road shows. Actually, markets went bad. Our numbers were not so great, and we couldn't get one-time subscriptions. And then in the middle of COVID, I think it was October of 2020, we decided to make another attempt. That time we had learned the lessons from the first time around. So I think we were able to pull it off within 6 months. This time oversubscribed 175 times. So I think it's, you just keep, pushing ahead, and hopefully it all works out.
Right. And it has been a similar experience for ixigo as well, where, it was the second time around when you, access the market. So, Alok, can you talk about it on, really getting it right in terms of timing?
No, I think it's very common for both of us, like in that sense. We actually made our first attempt by filing in 2021. This was a few months after Zomato went public, but the reason for our timing was very simple, that, we looked at our FY21 numbers, where lockdown was prevailing for almost half of that period, and we were actually the only OTA that had grown during a lockdown year and had made a couple of acquisitions. In fact, we were super confident about what the next year would look like in terms of profitability, and that was the reason why we actually filed. But by the time we got our approval, and then the market started to turn early 2022, we realized that we were swimming against the tide, because most of the new age IPOs, except perhaps yours, were actually trading below water, and the investor sentiment turned dramatically. So, I mean, my learning is you can only time markets in hindsight. I don't think we were trying to time it back then, but just got unlucky to be caught in that 2022, 2023, there were hardly any IPOs, right? And in fact, I said to myself at that point that, we'll come back much stronger as a company with far better metrics to show, so that people don't believe that 1 year was just a fluke. And we actually, when we came back, we were 6 times our pre-COVID scale. And we'd proven that we can get to double-digit EBITDA margin. So I think and I think in hindsight, it was the best thing to happen to us, because, and I'm sure you would have had a similar experience, because we got to meet public market investors early. We converted into a public company, started following almost all the norms that apply to a public company, and we got 3 years of net practice essentially before we actually got to ring the bell. So in a sense, I think I mean, something I recommend everyone that, yes, don't need to do second attempt, but at least start meeting public market investors 2 years at least before you are thinking of a listing. You get so much good feedback about your story. And if you're able to then beat the numbers when you go 2 years later, it also gives more confidence. So yeah, we also thankfully did that. We beat all the growth expectations they had, got a 98x subscription. I just feel lucky to be sitting here.
Right. While timing is one of the biggest factor of getting it right. I think pricing also plays a very big role. And, especially for you, Alok, your IPO came at a time when there was a lot of backlash for companies, new age companies that went public and then, did not really do well. So how did you take that feedback into account and, try to price it? Because, it's definitely that you priced it so right that the IPO is trading above the listing price, right? I mean, the stock is trading above the listing price.
Yeah, so I mean, for our IPO, we got anchor bids at all sorts of levels, but we basically just optimized for quality of investors. We wanted long-term investors, and if that meant leaving more money on the table, that was okay, because we just wanted to see a few names that we really wanted there on our anchor book, and most of those guys are still around, on our cap table. So in that sense, I think it's important to think about whether, because at the end, the IPO day price matters to what extent, right? As a founder, if you're building for the long term and you're going to hang around for a few decades, or till you retire, then is it that price that's going to matter, or will it matter that you actually left enough on the table for everyone who subscribed to your IPO to actually make money and remember that? So I think we just, in hindsight, just went back and said, okay, we're fine leaving more money on the table if needed, and but let's make sure these 5 investors we really want to see are in there. That's how we thought about it.
Right. To Alok's point about, doing the net practice before they really, went on the field, Nitish, how did you prepare for the IPO internally? And, because you said that, it also took you, 2 attempts to access the market. How has life really changed? Because, from being private to, driving a lot of decisions in-house, now, you are in public scrutiny. It does change life. So how has life really changed as, someone who's running the show?
Sure. No, we complete 4 years. I think, what's today, 29th, right? I think because in the next 2 days, I think 30th we listed tomorrow. So 4 years we complete tomorrow. It's been a very interesting journey. I think markets have been up and down. As you said, Nazara stock has done fairly well, even in the difficult periods. I think I'll just answer a bit on the question he answered earlier. I think as a management, as a founder, as a CEO of a company, you have to stand your position when it comes to what you want to do with the IPO, because a lot of different stakeholders will have different views. During our IPO in 21, I do remember, because the demand was so high, there was a lot of push to increase the IPO price, right? And we fought back a lot, because the whole idea was to price it right, not only for institutional investors, but also for retail investors. And I think that is one of the very important reasons Nazara has done well over the last 3-4 years. Because had we overpriced it, and once your stock falls 50%, then it becomes a very challenging situation, because you lose the public trust.
It then becomes more psychological also for investors.
You tend to lose the public trust. I've enjoyed the last 4 years a lot, I would say. A lot of people scare you saying going public has so many issues, right? I think one is people are always scared of quarterly, all the hygiene when it comes to all the compliances, etc. But I think if you're having fairly good corporate governance, more importantly, as long as your intent is positive, I think public markets are okay, right? As a business, you will always make mistakes. You will have tough quarters. You will have good quarters. I think positive intent, right, and transparency. I think these 2 things are very important. And I'll give you one example. A couple of years back, when the bank in US went bankrupt, a big one, we had, one of our subsidiaries had some 60-70 crores stuck over there. And this happened on a Friday night. I was advised to wait till Monday morning, because it was expected that US will intervene and solve for it. But we actually went and made an market intimation on Sunday morning. We were the first company in India to make that, public company to make that intimation, and obviously we became the poster boy, everybody carried it. But I think when I met investors later, they actually appreciated it, right? That we were quick to make those intimations. So I think as long as you're doing the basics right, there's no stress to that extent. Of course, public markets are much more scrutiny, but it's also positive, because you're not a cowboy anymore. And there's a right age and a right time to do everything, right? What you can do in college, you can't do after you're married. Same way, I think as a public company, there are certain responsibilities, but they are positive. I don't think they're negative.
Right. When you say that, there are a lot of responsibilities, at the same time, when you're a private company, there are a lot of decisions that you can take, on your own and, just go by your conviction. And one such thing is inorganic growth plans, where, you can plan inorganic growth, better, and you can execute them faster. Here, as a public company, has anything changed? Because Nazara has acquired a lot of companies, and so has ixigo. So I would want to hear it from both of you on how, inorganic plans can be executed in public. Does anything change?
No, I haven't found any change as such. In fact, I found it to be easier because as a public company, the management and its board, right, takes the decisions. You don't have to go to individual investors for approvals, etc. Compared to a private company which may have raised money from VCs and institutional investors, where a lot of them have, rights which you have to get it approved. Of course, for material decisions, you have to go to the public shareholders in large.
But there's always a worry that it might impact, how the investors are going to perceive that move, right? And whether it would impact the stock price.
I think you can't run a public company if you can't run a public company well if you're worried about the short-term stock price, right? You have to take the right decisions, what you think are the right decisions, what your board thinks is the right decision from a medium to long-term approach. And you will make mistakes, but you have to be transparent in accepting those mistakes and still do the right thing, what you think. Because the investors have invested in you, your company, your management, your board, because they believe that you have the experience in that particular business to take the right decisions for them. If we start doing what, a lot of different investors will have different views, right? So it's very difficult to start tweaking your business model or your strategy based on what individual sets of investors will want you to do. That's again my personal opinion. Alok may have a different opinion.
Yeah. Look.
I think when it comes to M&A, right, communication is very important. It's important to communicate why you're doing it and what that brings to the table. But then again, there will always be some people who do not understand it. And one advice I always have for people going public is that you have to be willing to be misunderstood for a very long time. This is something Jeff Bezos said when he was launching AWS, and for many years, people did not understand what he was doing. But it's very true, right? So in a sense, it's sort of self-selection, right? So if you're a company that's optimizing for building for the long term, in the short term, some of your decisions may not make sense to the wider public. But there's a small subset of long-term shareholders that you want to attract on your cap table who will understand what you're doing and support you because they've seen your track record, right? And, public markets tend to shortchange track records and only focus on the next quarter. But if you're building for the long term, it shouldn't matter to you. And I think one has to become, in that sense, of course you have to do it in a measured way and communicate it right, but then you have to become a little thick-skinned in that sense. And there's so many examples of great acquisitions which at the time they were announced was not understood by anyone. As long as the track record of the founders on extracting the synergies, keeping the team, etc., incentivized to grow with them is there, I think there's no reason why. The best, name any large, at least in tech, consumer internet, name any one large consumer internet company who does not, if you think of fundamentally, why they exist today, if they didn't make those acquisitions, they would not exist. If it's Google, Meta, you just go back and look at their history. Some of the game-changing acquisitions they did have become their raison d'etre today, right? And I think so it's very important actually to, keep on the lookout for great teams and great acquisitions, especially as a public company when you have the currency, you have the ability to raise more money. It's actually a great strategy if you're able to get the DNA and cultural fitment right.
Right. Nitish spoke about, being, making mistakes and, being transparent about it. Do you think that scope of making mistakes just, reduces when you are a public company?
I think there are two things. One is obviously what is the magnitude of the mistake, right? If it's a magnitude that severely damages the company, then of course it's a problem, right? And there are a large number of shareholders part of this. So it impacts a very large number of stakeholders in the company. So as a company and its management, you obviously have to be very mindful of that. that what is the magnitude of making mistakes. At the same time, especially in fast moving technology businesses like ourselves, if you will not experiment a lot of things, you will get obsolete in any case, right? Because I think one of the biggest things in technology is the march of time and the march of technology. It's evolved so fast that you can either lead from the front or you can become obsolete over a period of time. So I think smaller, well thought out, well contained risks are worth taking a shot at. And if, like Alok said, communicated properly in all transparency, and it's evident that it's all done in good faith and with the right positive intent and effort, then I think all shareholders are quite forgiving,
Right.
is what I've seen.
Right. You both make it look like it's a cakewalk to be going public, but I'm sure there are challenges as well. If you can just talk about the biggest challenge of being a publicly listed company, one each, that would be great.
I would say one, I would say you have to be very transparent, and you have to understand that even one person with one share in your company has a right to question you and accept that, right? I'm quite happy with even saying what I ate for breakfast. It doesn't really matter, right? So I think that's very important thing to accept and understand and actually follow through.
Right. Alok?
I think it's important to sort of, set the right expectations, because, the mistake I've seen people make is sort of overcommit and underdeliver, especially at the time of IPO. And so you just can't miss your first 4-6 quarters. I mean, it's just hygiene not to miss your first 4-6 quarters, right? Like, if you don't have the confidence, don't come and list, right? And I think in that sense, it's tough because it's nerve-wracking for the team, because like you have basically the rigor that is needed there to meet whatever you're projecting every quarter. As a private company, there's more tolerance for misses, because you have a couple of investors on your cap table, who are sort of okay if you miss the plan by 10-20%, because they're still going to make a crazy return anyway. But I think as a public company, the scope for those misses become, sort of, it's not there, right? The market punishes very heavily. And so there's no room for hubris there. I mean, it's important to sort of undercommit and over-deliver. And I think the batting practice we got in those 3 years probably really helped in that sense, because at least, for us, we were reporting our numbers every quarter internally to our board, which was an independent board, and sort of got that rigor of saying, okay, are we meeting whatever we are projecting for ourselves? And at the time you believe you can actually do that is when you should go and list, right? So it's important to, that's a critical test for, are you ready?
Right. The conversation is so exciting that I can go on and on, but I would want to open the floor for some questions. If, someone from the audience wants to ask. Yeah, the gentleman over there.
Yeah, glad to listen to you guys. And so my question is, if you look at the corporate India, some of the observations as a banker we got, like when you tried for IPO in 2018, I guess few months back, DMart also got it listed. Industry was having average price earning of 70, 80. Mr. Damani positioned itself at price earning of 28, 30. It got a fairly amazing response. At the same time you tried, the IPO did not got successful. The same thing with when you tried for IPO, Tata Technologies. I mean, who does not want to put money on Tata being large conglomerate? Industry was at very interesting price earning at some 70, 80. A lot of guys like Keynes got listed, but they positioned themselves at a price earning of 25, 30. So my point is, do new age guys really mean that they wanted to leave something on table for investors, first thing? Or there are kind of some kind of a imminent pressure from the private equity side to cash out on the opportunity? Because if we closely look, both the IPOs, opportunity got failed. But then at the same time, some great companies flourished like anything at that time, like Supriya, when you tried, PB Fintech. So how exactly?
So I won't comment on any specific company, but what I'll say is something what Nitish already pointed out, that you got to control that process as a founder. You can't let the banks or your private equity guys, etc., control that process, right? You have to call the shots at the end on, does this make sense for wider shareholder base that we're going after? And if there's even an iota of risk, you're better off pricing it even lower, which is exactly what we did, by the way, because the market was still kind of, the day we filed our RHP was the day the election results came. The market was down 6%, and the banks were actually kind of jittery, saying, are you sure you want to do this, Alok? And I was like, I know, I'm confident in my numbers are solid, right? Why would I wait, right? But the fact is, because of that, maybe we just went conservative on the price because we didn't want an iota of risk there, right? And in that sense, I'll not comment for the larger new age ecosystem, but I think it's sometimes there are constraints that companies may have. It's important as a founder to sort of push back those and just say, like, this is what makes sense at this point.
Any other question? Yeah. The lady over there.
My question is to Nitish, sir. So, so where will Nazara invest next that will drive its future?
Where will Nazara invest next, and?
That will drive its future.
Yeah, and are you a shareholder?
Yes, I am.
Okay, then I have to answer it. I think for us, the gaming IP business, and we've made many acquisitions of gaming studios in recent times, including a studio we bought a few months back in the UK, is an extremely attractive opportunity at this point of time, and we'll continue to double down on that particular opportunity. We've also got about 10% allocation to experimenting on all new technologies in the gaming world. Right now in the gaming world is undergoing a lot of transformation. It usually is, but this is a particularly very fascinating period where you have multiple macro level technology changes happening. So I would say AI, of course, being a very important one, which is disrupting all industries, not just gaming, but definitely gaming. Virtual reality is coming at us fast. It's been coming for a long time. It's been on the horizon for a long time, but it's getting nearer and nearer, and I think it's a game changer for our world. And third is the Web3. Again, it's gone through its own cycles of hype and pessimism, but I think digital asset ownership will become something very big in gaming. So I think we're always experimenting with new technologies as well, so that, again, like I was saying earlier, we don't get obsolete, right? So I think existing business, gaming studios, is something going to go after. The largest acquisition we did earlier this year was of PokerBaazi, which is India's largest online poker platform. But core gaming studios is what we will go after in 2025.
Thank you.
Right. That would be the last question from that gentleman, and then we'll wrap up the session.
Thank you. So my question is to both of you. So how long, it took your respective companies to become IPO ready? Like how many years of, since you decided that we can become public, how many years it took? And as a founder, is it more like, I have to list in 3 years, so you start working backwards that I have to do all this every quarter to get it listed? Or is it more like a process when you're just focusing on building and then IPO is more of an outcome? It's not a thought out process that I have to list and then I work backwards. How do you go about it?
I think, good question. I think a lot of it should be outcome, because it's much easier that way. So for example, in our case, Westbridge Capital invested in our company in 2005 when we were a very small company. And at that point of time, the partner there, Sandeep Singhal, who I worked very closely with, recommended that we bring in EY as our auditor. And we were like a few crores revenue company, and I was like wondering, why do we need a auditor like EY, right? Because I would personally spend 1 month before the year end just sitting with the auditor trying to get it sorted. But the lessons learned over a long period of time really came in a lot of use for us when we attempted to IPO in 2018 or finally IPO'd in 21. Small things like corporate governance, no related party transactions, etc. Right? So I think now what's happening is startups that are starting today, right? The IPO cycle is potentially much, much faster. It's not like 25 years, let's say what a Nazara story is. It's probably 3 years or 5 years out a company can easily IPO. which means the learning curve is going to be much shorter, everything is going to be much shorter. So I always suggest to all startups that from day one, if you can try and keep a basic governance, basic all of these in place, when you try to go IPO, it will be much helpful. But also companies that are generally planning an IPO, I would say they need to start thinking at least a year, 2 years ahead of it. Start building quarterly numbers, start cleaning up a lot of their paperwork, ROC filings, etc. Right? There's a lot of minute details. You need to start working a year to 2 years in advance of actually listing the company.
No, I think very similar. It's important to, there are two parts, right? One is the governance and compliance parts, which I think even on day zero when you incorporate a company, right, it's not something you can push aside. I mean, essentially, governance is in the founder's head. The way the founder is comfortable running the company is what defines governance. And I think from day one, you should be like zero tolerance about some of those things, right? Because that culture is hard to change later on. I can promise you that. The other thing is that, you should only think of an IPO if you are actually sure that you are trying to build a company that lasts or a company that's generational in nature, right? Because it's not a path that is for everyone, because there are some companies where the nature of the business is such that there is a high, let's say, disruption risk, or there is a high chance of pivoting over the next year or two in a much more dramatic manner. And I think some of those things, if you have too many moving parts at the time you go public, it's also not the best time. And then if the size is not big enough, you don't get coverage, or you won't get enough large FIIs coming in, or the large DIIs coming in, because they might have certain thresholds. So it's important to sort of make sure you take all those boxes, which are pretty hygiene, before you actually go ahead and start planning it. But like we discussed earlier, it's better to actually dipstick the market 2 years prior to when you think you want to list. It's great feedback, because you might believe a certain version of your story. Trust me, the public markets look at your story from scratch. It doesn't matter what track record you have as a private company. I think the public market needs to understand your story just like a public market investor needs to.
Right. It was great, getting the do's and don'ts about taking a private company public.